Welcome to the Energy Show. I'm journalist Markham Hislop, and the working title for today's show is U.S. Economy Trump-Proof, or is the worst coming soon? My guest today is economist Ed Hurst, the University of Houston, and a frequent media commentator on American economic issues. So welcome back to the Energy Show, Ed.
Thank you, Markham.
And I have just a quick word for the viewers. If you're interested in supporting our work and you're watching on YouTube, we've just today launched our membership. You'll see it up in the tabs, and you need a YouTube account to log in to become a member. But there's all sorts of benefits in 4 different levels. Check it out. We'd really appreciate your support. Okay, Ed. The reason I asked you on is I read this Wall Street Journal article. The headline, U.S. economy shows remarkable resilience in face of trade turmoil. And really what it does is it lays out an argument that U.S. economy is kind of shrugging off the drag of the Trump tariffs. And just from an overview point of view, how would you respond to that?
Well, it's going to take a little bit of time for the impact to really be felt. As the president said himself, if you take away the negative numbers, GDP did really well in the first quarter. All the negative numbers, of course, are what we're paying attention to. The U.S. accelerated imports over the past several months, primarily because a lot of the U.S. companies wanted to pre-position goods and accelerate as much as they could out of the supply chain. The changes that have come in, especially for the exemption for the sub $800 items out of China, that's going to hit big time this month. We know that the steel tariffs came in at 25%. Those haven't been lessened at all. That, of course, gave the U.S. producers, those who remain, an opportunity to raise their prices by 25%. The layoffs that DOGE has inflicted across the federal government has led to an additional 50,000 homes on the market in the Washington, D.C. area. Now, keep in mind that the U.S. has a very robust unemployment system. And so it's designed to cushion the impact of these layoffs, but it's not nearly sufficient to compensate these high wage earners. Here in Houston, where I live, MD Anderson has cut back on a number of programs. The Baylor College of Medicine announced over 100 layoffs. Research facilities across every major university in America have been cut dramatically. And Trump keeps, flip-flopping on the imposition of the tariffs, especially with the auto industry. But, the impact's coming. I would liken the comments here by the journal as well. They've kind of missed the point. If on the Gulf Coast where I live, a hurricane comes in, we see a great spike in consumer spending right before the hurricane hits, and then it's kind of a long haul to get out of the aftermath.
You made a point to me off air where you said that the Wall Street Journal economists are confusing resilience with inertia. What did you mean by that?
Well, the U.S. economy has been very strong. Keep in mind that President Biden left and turned over a robust and growing economy. We're now looking at numbers that, as leading indicators, indicate terrific weakness. The U.S. dollar is down 10% since the election. That means our purchasing power for any goods made overseas has been diminished by 10%. We've seen the stock market down as much as 20%. I think it's around 10 or 11, 12% down now. Seniors across America looking at their 401ks now have a lot less to spend. We're seeing the tipping, if you will, of real estate prices. We're seeing inflation across consumer goods. McDonald's reported same-store sales dropping by a rate that they've never seen before. It's a pernicious and widespread weakening across the U.S. economy brought on by inflation and cuts in direct government spending.
One of the questions I wanted to ask you is compare Biden with Trump, because Biden brought in a number of spending bills. We have the Bipartisan Infrastructure Act, the CHIPS Act, the Inflation Reduction Act. I mean, all of those together would have been well over $1 trillion, I would imagine, over 10 years.
Much more.
Yeah, and then on top of that, it crowded in the government money crowded in private capital, and in some cases it was like an 8 or 10 to 1 ratio. So there was a tremendous boost of capital investment over the last 2, 3, 4 years, and it would seem to me that it was strategic. The government said, we clean energy technology, semiconductors, we have supply industries and supply chains we want to reshore and expand and become competitive in. That's if I was thinking as an economist, I would go, okay, well that seems like a good strategy versus Trump, which just puts on tariffs and willy-nilly and changes them all the time, which is, I mean, it's chaotic. And is that a reasonable summary of the two approaches?
It's pretty good. There's a difference between being an armchair quarterback and somebody who's actually on the field. And there's a difference, between being an armchair economist in the Trump administration, reading a 19th century textbook, and actually, helping manage the economy, the volatility, the uncertainty. That's what's really hammering investors right now. The tariffs, because the U.S. was in a trade deficit, that meant that more dollars were going overseas or going to our foreign trading partners. Well, as our trade machine slows down, those dollars are not going to be coming back into the U.S. economy because they came back in terms of bond purchases, stock purchases, and we've seen that. We've actually seen an incredible weakness in the U.S. Treasury market, which has not been seen at this scale before. That's what caused Trump to flinch 3 or 4 weeks ago. Um, the tyranny of the capitalist system. It just doesn't like tariffs. And keep in mind, eventually the U.S. consumer is going to figure out that tariffs are a tax on their spending. China's not going to pay dollar for dollar on a tariff. Canada's not going to do that. This is a tax that is not an income tax. It's a consumptive tax, a consumption tax that is going to really undermine the low earners and the low wealth members of the U.S. economy.
Speaking of that, the Wall Street Journal noted that employers added more jobs in April than economists expected. And the employment rate stayed near historic lows, and the labor market is still tight. But does that kind of underscore your point about, that's created by the inertia of the previous robust economy, and we will, in the not too distant future, see the effect of the Trump tariffs and inflation, and they'll affect job numbers?
Yes, we don't see the impacts right away. There will be a decline, no question about it. Um, let's talk about energy right now. So, WTI closed well into the 50s this yesterday. OPEC Plus is looking to add another 411,000 barrels a day in the month of June. That's going to knock the price down, another 750. We could be in the 40s by the end of summer, which is what we talked about on the last show I was on. Uh, you know, and then we get the Secretary of Interior, Doug Burgum, talking about the U.S. having a sovereign wealth fund investing side by side with oil companies to drill wells. I mean, if it's non-economic for a private company to drill, how would it be economic for a sovereign wealth fund to drill? Is the administration actually going to pursue a socialization of the oil patch? I mean, my goodness. Um, they're talking out of both sides of their mouth, and that uncertainty is just devastating for investors in Wall Street.
Let's talk about the energy industry, because most of my interviews with you over the years have been as in your capacity as an energy economist, area you know well. So the U.S. right now is the biggest oil producer in the world, 13.2 million barrels a day. At least that was the last data I looked at. It might be less now. And we know that we're starting to hear rumors that especially in the shale plays, which is a lot of the U.S. production, they've used up the what is it, the type one or the grade A,
The sweet
the
spot. Yeah,
sweet spot.
they've told us they've been drilling the sweet spot for 15 years. Well, eventually, it becomes less sweet.
And so we're seeing break-even costs rise, which makes the shale oil less competitive, and seems to work exactly the opposite effect to Trump's drill baby drill energy dominance narrative.
All right. Yeah, drill baby drill can't work. Um, we've known this for years. The Dallas Fed at the end of 2024 uh, ran a survey, and more than 85% of the respondents said that they would not invest, they would not drill new wells if the price of oil was going to be less than $70 a barrel. And if we just take a look at the forward curve, you can see that's not the case. Now, the Energy Information Agency released this week data showing that the oil patch, the US oil patch, is a lot less leveraged than it has been. So the oil patch itself is in a better position financially than it has been for previous downturns. Keep in mind that U.S. equities in the oil patch, this is the worst performing sector across the Standard & Poor's index. It has been for the last dozen years plus. Wall Street's just not putting money into oil and gas, and not the high cost producers. The areas out in the Permian, that's 4 million barrels a day. A lot of it's very light stuff that goes out as NGLs that actually doesn't achieve the same price as WTI, because the U.S. has essentially flooded the market with exports of things that we used to have to make in refineries. And so the price received for that is less than half of WTI. And so the cost of getting that real barrel of crude out has gone up as the wells become gassier, as more of the light liquids are produced. We have all the light oil and light liquids we need for the U.S. We have to export them now, and that's a challenge. It's an issue of matching up what we produce with what we need and what we can refine.
Right. And just for some viewers who aren't aware, NGL means natural gas liquids,
Right.
which are often used in petrochemicals like ethanes and propanes and so on. So Ed, you referenced the OPEC's decision to increase production in June by 411,000 barrels. This is starting to look reminiscent of late 2014 when the Saudis basically, well, OPEC opened up the taps and drove the price down to, I think at one point, it was like 23 bucks a barrel or something, but it was low. And the idea was to drive the shale producers out of the market. Didn't work because the shale producers innovated. Are we seeing a repetition of the Saudi and OPEC strategy?
I think we are. Trump called for lower oil prices all through his administration, Trump 1.0, and even considering and eliminating the downturn due to the COVID shutdown, which he presided over. The average price of oil was less in Trump 1.0 than it was during the Obama administration or the Biden administration. And driving down the price of oil domestically does nothing to encourage producers to drill in the Gulf of Mexico, to drill on the East Coast, to go up to Alaska to look for oil. I mean, this is a high cost problem, and the U.S. can't compete on price.
Right. I mean, I think the average price break even for production, not for all the other stuff that they need to use the revenue for, it's about $25. Norway's $27, something like that. And I think we were talking now with the Permian about 55, 60, maybe even $65 a barrel.
Yeah, if you're looking to make a return on capital for the investors, it has to be that $70. And so what we're going to see is a very, very rapid decline in the rig count across the U.S. We will see production kind of, well, it already has plateaued. It plateaued in late 2024, and it will begin to diminish pretty rapidly towards the latter part of this year as the shale play and tight formation wells play out. As we know, they do 80% of their production in the first 2 years.
So here's a question from Canada. Um, we saw Trump apply a 10% tariff, which I haven't looked lately. I assume it's still on. With Trump, I mean, you have to check day to day to see where the tariffs are at. But the point is that there was a lot of concern that the Canada's 3.3 million barrels a day of ultra heavy sour crude that's going into the Midwest, some down to the Gulf Coast, some to the Rockies would take a real hit. But it seems now that if there's going to be a decline in U.S. light sweet production, that actually has the Canadian producers in a pretty favorable position.
No, I don't think so. That's a little premature. The
Okay.
U.S., as I said, produces much more light sweet than it needs by 3 or 4 million barrels a day. That would that's enough to not only satisfy our light sweet crude refineries, but supply some to the rest of the world. So we're going to have to really see a significant drop off in our production before we start turning towards the heavier crudes as a solution. Um, that's not a bonus for Canadian
Oh,
producers,
okay.
but because the U.S. dollar has fallen by 10% against the basket of foreign currencies, and I haven't looked it up against the Canadian dollar, that would tell you that the tariffs have been offset by the decline of the value of the U.S. dollar.
So, and let's close up the interview with this. Where are we at with the Trump tariffs? It's been, we followed them closely in the first, I don't know, 2, 3 weeks or so. And then it just got so chaotic. I mean, it was literally changing almost on a day-to-day basis that I know for myself, I stopped paying as close attention. So, where are we at with those?
Well, the tariffs are still pending. Some of them have been put into place, and U.S. manufacturers, U.S. Assembly plants, or U.S. importers are trying to figure out which way to go. In other words, where do I bring my product in? Do I bring it into Long Beach? Do I bring it into Houston? Do I bring it into to Michigan? Do I bring it into Mexico? Am I going to make it in Thailand, Malaysia, Vietnam? Where is it going to go, and how's it going to get there? And so this uncertainty is driving a lot of costs across the U.S. But the absolute tariffs on steel and aluminum, those have hit. Those are real. That's a problem for U.S. construction. That's a problem for road rebuilding. That's a problem for the oil patch. It's driven up the cost of drilling for oil in West Texas by anywhere from 5 to 15%, depending upon how long these laterals are.
Here's another question for you. I just thought of. I've heard it said that the ports, particularly on the coast, like at Long Beach, are basically empty because the
Yes,
high tariffs on China has stopped the flow of low cost goods. And when will consumers see that hit the stores?
I think it's working its way through the stores now. I know, for example, well, anecdotally, one of my friends bought a Volvo 2 weeks ago and went to go pick it up at the dealership in Minnesota, and it was surprised to see the lot pretty well cleaned out, and the sales rep saying, "Yeah, we sold 54 this weekend. Usually, we only sell 4." The CFO of a family of import car dealerships out in California said that they're flying out of the dealerships, and of course that contributes to a positive GDP number for the U.S. That contributes to positive labor count. But once those inventories are depleted, once the car dealerships don't have any inventory to sell, That's an issue. And so we're seeing automobiles kind of pile up at the loading docks in China, loading docks in Germany, across the EU. If you want your BMW, you should have bought it 2 weeks ago, that type of thing. The parts are a big problem. And, finally, it seems the industry has gotten through to the Trump administration and explained to them it's going to take years and years and billions of dollars of capital investment. And if we take a look at the stock prices of GM and Ford, the market's not quite willing to give them and advance a huge amount of equity to them just right now to accomplish this reshoring.
Yes, at a time when they're all trying to finance the switch to electric vehicles with the profits from the combustion engine sales. It's a mess. Well, Ed, thank you very much for this. You've illuminated the problem very well for myself and for our viewers. Thank you very much.
Good to see you, Mark.
Thanks for watching the show. We are on a mission to reach 10,000 subscribers and over 1 million views. If you're enjoying the content, give us a thumbs up, share your thoughts in the comments, and subscribe to our channel. Thanks for being part of our community.